Hi everyone, I'm Mary from UOW Malaysia KDU.
As part of the COVID-19 series, today we will be focusing specifically on IFRS 9, Impairment of Financial Assets. Some governments have announced payment holidays as well as reducing interest rates. Despite the relief from lenders, COVID-19 has impacted the ability of borrowers in meeting their obligations, be it corporate or individuals. As a result, companies face declining sales and unemployment rate is up due to the loss of income. As such, uncertainties relating to COVID-19 may be very significant. Banks have given loan to individuals and companies. It is now doubtful whether the loans will be collected. Reduced interest rate indicates that loans are not at a market rate. Borrowers may even take longer than normal or even stop making payments. So how does it affect financial assets in the book of lender? Remember, financial asset includes both debt and equity instruments. But our focus today is mainly on debt instrument, which includes loan, investment in bonds, intercompany loans, and even trade receivables. Do take note that COVID-19 affects preparation of financial statement with year ending after 31st December 2019. Estimating expected credit losses are material for financial institutions and even corporate companies as they face the greatest challenge in updating it. So how does the ECL model work? It is forward-looking, which takes into account of all reasonable and supportable information of the past, current, and future, meaning you have to guess how much of this loan may not be recovered. IFRS 9 financial instrument is a principle-based standard and purely judgmental. ESMA emphasizes that entities should reflect them faithfully as there is no bright line to go about this. Expected credit loss is a technical area and was recently tested in your March exam, question 1B. And there is also an ACCA article with regards to this topic, which you should read. Let's take a look at the examiner's comments. Only few candidates demonstrated a clear understanding of the ECL model. There was general lack of confidence and answers were too brief and not well explained. So what's the moral of the story? You have to revise in order to be well prepared. IFRS 9 has introduced a general model of recognizing expected credit loss in line with the stages. There are 3 stages. Stage 1 refers to performing loan. In other words, credit risk is very low. However, you still have to recognize 12 months ECL, and interest is based on gross carrying amount. Stage 2 is when the credit risk of the loan has increased significantly, meaning borrowers are facing cash flow problem and payments are delayed. Then entities should recognize a lifetime ECL for the remaining life of the loan. Interest revenue is still based on the gross carrying amount. In stage 3, financial asset is said to be credit impaired. This is when the borrower starts defaulting on loan repayment, which is overdue for a few months. So entity needs to recognize lifetime expected credit loss, but the percentage of default is higher than stage 2. Interest is based on net carrying amount. A low credit score indicates significant increase in credit risk and affects staging. But the good news is, deferred payments during the payment holidays will not affect the credit score of the borrower. According to ESMA, when a borrower takes advantage of the deferred payment, it does not automatically trigger a default and not necessarily breach the loan covenant. So why then do we still estimate expected credit loss in the current scenario? Because ECL is a forward-looking model, so the impact of COVID-19 has to be incorporated in adjusting the allowance for loss. Entities should not overstate ECL based on unsupported assumptions. Assessment is based on the rescheduled payments, which takes effect after the payment holiday period ends. So there's a likely movement between the stages, then the allowance for ECL should be adjusted. But you must also remember it does not mean that all borrowers will move between the stages, from stage 1 to stage 2 or stage 2 to stage 3. Some borrowers may have opted out from the holiday payment. Thus, credit risk may not have increased, and it remains at stage 1. So that would be all for today. See you next time.